All right. I looked at the clock again and, we are all here. It looks like a bunch of other people just jumped on. So we'll get started. Like I'd mentioned, a lot of information to get through. And, obviously these are difficult times for everyone on a lot of different levels. Today we're going to go through how best to manage your wealth, your investment portfolio, make sure that it's aligned with your goals, and how to get through times like these, and also get into certain opportunities when it comes to taxes, how to take advantage of this, what tax planning strategies might make sense. And even though we do have an hour, which maybe seems like a long time, we do have a lot of information to cover, which is why I didn't want to delay this anymore. So hopefully everyone is doing well, staying safe. Unfortunately, I think it takes times like these, and maybe, I'm speaking personally as well, to remind us that, I think we do take a lot of things for granted, being able to go outside, and see people and interact and have that social interaction, which I know means a lot to me. But, today's topic is, managing your financial, health and or wealth, right, as we go through COVID-19 and the coronavirus situation. And, as I was preparing for this, each day, obviously, new news is coming out, markets are acting, differently, last couple of days in a good way. But, some of the statistics and things that we'll go through, of course, and I'm sure everyone understands, might be a day or two out of date, but it's impossible to keep up on. So, I know for those of you that are already on, I briefly introduced myself, but now for everyone else as we're getting started, my name is Mike Bernier. I'm a certified financial planner, practice here in San Diego. And really my focus for the last really 10 years or so has really been on how to produce tax efficient retirement income. So a lot of our talk today will revolve around taxes, which I know for some that might not sound super exciting, but for me, it's something that I enjoy. And when we start talking about markets and things that we have control over, the bottom line is right now, as much as any other time, there's not a lot of things we have control over, right? But there are certain things, and taxes is something that we have control over. So we will spend some time there today on, how to potentially take advantage of the volatility in the market, and save some money in taxes or defer, taxes over the long run. So at the end, I am going to open it up for some questions. But I know in preparing for this that since we do have a lot of information to get through, I'll get to as many questions as possible. But then, I'll offer some contact information if anyone wants to chat more, get specific questions answered. I really want to just try to get as much information out there as possible. In talking with the other members at Canter Wealth, just during these times, we want to try to get as much information and education out there, because I think, there's a lot of information out there, but it can become, overwhelming, and especially with what's going on right now, it's hard to filter through. So, we want to get, as much as we can to you. So, what I'll do is I'm going to jump into it, and then, like I said, I'll open it up for some questions. But if we look, I mean, really, with what we're dealing with right now, right? I mean, with the the coronavirus or the COVID cases, and again, these might be a day or two out of date, but now 500,000 people infected. Now I just saw that we crossed over 20,000 deaths. U.S. cases, continue to build. I think the most recent is about 60,000 cases and 800 people have died. And so, I mean, awful times on so many different levels. India, now has just instituted a 3-week shutdown. If we look at like the stock market, which we'll get into in a second, of course, yesterday was a really good day. It was actually the best day in terms of points gained and as a percentage gained in one single day since 1933, back at the Great Depression. The U.S. dollars, doing really well. But if we look on, the market side of things, I mean, really since late February or mid-February, I guess, overall markets have lost about $26 trillion. And so, of course, that's concerning to a lot of people. And I think that's where a lot of what we'll go in today comes in is, okay, well, how do I manage my, finances during these times? And, what is the appropriate strategy moving forward? So, that's where we'll start. Now, what's been, beneficial too is there was, it's constantly getting updated, but some, new updates and all the details are getting ironed out. But, when we look at this $2 trillion stimulus, which is the, largest in U.S. history, this is at least what I'm seeing as the current breakdown. $250 billion, going out to individuals and families, $350 billion to help assist small businesses, $250 billion to help with unemployment insurance benefits, and, half a trillion or 500 billion, for loans for distressed companies. And, I think, why the market, of course, is reacting positively is that this is good news, really, because it's going to be needed, and I think that's where a lot of the concern comes in with, how do you manage your finances or your portfolio through these times is, okay, well, I think we can all agree that, even outside of the emotional or the personal level of what the markets are dealing with, and what we're dealing with as a society, businesses, will likely go out of business. There will be, probably a significant amount of layoffs. People are going to struggle through this. So, getting some stimulus or support is absolutely needed, and that's why we've seen over the last couple of days, a positive reaction in the stock market. But, if we look at this, and of course with anything, this is always difficult, especially when we're going through trying times like we are, that, it could always be different, right? And I think that unfortunately that's where our mind does go to is, okay, well, is it different this time? Does the stock market not work the same way? And although anything could happen, and, the fact that things have happened in the past does not guarantee, it's going to happen in the future. But if we let history be our guide, we have been through so many things, in the past, and we have always gotten through it. But without a doubt, I never want to discount the fact that, there will be some struggle through this. But if we look at, some of the worst downturns, or I guess the worst downturns in stock market history, or the U.S. stock market, if we look, of course, this top one, this is, during the Great Depression. So, the market was down around 83% during that downturn from 1929 to 32. And it's a little harder, I think, probably for all of us to wrap our mind around, the Great Depression in those times. But, the second in line was not that long ago. I guess it was a little while ago now, but, the end of 2007 to the beginning of 2009, referred to as the Great Recession, the financial crisis we were going through, that was the second largest downturn that we had in market history. So, it was about a year and a half, and it was down around 55%. If I scroll down, though, right here, and this is updated, as of yesterday, this is the current downturn that we're going through. So, really starting about the middle end of February until now, which has only been, which seems like a lot longer, right? But, it's been about a month. But the market's down around 35%. Now, today there was, positive performance, so that'll help out. But really, when we start getting into how you want to have your portfolio constructed, you don't want to be making decisions just based on what's happening over a short period of time. So why I, don't feel, like this has to be updated, on a daily basis. I think it's important to show where we're at. But, anything could happen moving forward. And of course, we don't know. Right here under this column, next year's return, that's an unknown. The next 5 years is an unknown. But I think what it really comes down to is if we look at all these worst downturns that the market's ever had, in this column here, the subsequent year ends up being positive returns. And the bottom line is, sometimes it ends up being a pretty large return. And, it's difficult where we're at now, because if we look at the, the expectation, or we look at, what we're probably going to see in terms of whether, recession or businesses or individuals struggling, like the news is not good, right? The outlook is bleak. But the thing to remember when it comes to your investment portfolio is that the market's driven on expectations, right? So right now, all the public information that's available and, what we're pricing in terms of how bad this is going to be, has been priced in. So now what is going to drive the market to either continue to go up like it has the last couple of days, or, continue to go down is that new news, right? So of course that's unknown, right? But as that new news comes out, that's what's going to drive the returns based on those expectations. So, what I've been talking about with my clients is it's not that the market's going to turn around if we're in the clear, right? The virus is no longer a concern. Everyone's fine. Businesses are up and running. Individuals are out spending money. We don't have to get to that level. What we really need for, the market to turn around is just continued news that things aren't as bad off as what we're expecting. And, at least for me personally, I think we're expecting, some really bad things to come. But again, if the market's driven on expectations, that has been factored in, to the current pricing. So again, no guarantee that this is going to continue to happen, but, if we look at, some of these large downturns, the following year did end up, and of course the 5 years after ended up being some large returns. And, and also talking with clients over the last few weeks, kind of going back to what's still fresh in our minds, maybe not as fresh as it used to be, but 2008 and 2009, when we went through that financial crisis, I think a lot of people, at least based on some of the conversations I've had, forget, how bad that was. I mean, we were close to just a complete financial meltdown. If we look here, like, let me do this. I'm going to come right back to this. But if we look at like these declines, go back one right here. So in intra-year declines. So I think this is something to put things in perspective. And I'm not going to dwell just on all this data of, okay, well, here's what's happened in the past. So, it's likely to happen. We are going to get into how to build, a prudent portfolio during these times, to make sure you're set up for the good times and the bad times, and how to take advantage of it potentially, from a tax perspective. But with the news and the media, and the fact that now a lot of us are stuck at home, I mean, all we can do is just digest all this information, and so it's kind of information overload. But what this chart's showing is the bottom line here. I mean, we don't have to go through, obviously there's a ton of numbers on this chart, but what it's showing is that bottom red, or the bottom of that red bar, would be the worst point that the S&P, or actually this is the Russell 3000, but the worst point that the stock market got during the year. But what the blue bar is then showing what the total calendar year return was for the entire year. And it is really easy to get caught up in these red dots, or the bottom bar, because again, we've got news so accessible to us. So we're constantly seeing this information. And most recently, there's been a lot of talk about 1987, which I'm sure a lot of people remember. That was the infamous Black Monday, where the stock market dropped 23%, in one day. Well, what this is showing is in 1987, yes, at the worst point, it was down 33%. But when it was all said and done, not a huge return, right? But the return was 2% for the calendar year. Or if we go more recently over here off to the right, this is 2008 and 2009. That was that financial crisis, where at its worst point, it was down 49%. It's not labeled here, but, I believe it ended the year, around negative 33, negative 38. So, I mean, it was better. It's hard to say that that's better, but the market did recover a little bit. But then if you remember, early 2009, the first couple of months there just continued bad news, to where then the first couple months, bottomed out now, we know, in early March of 2009, but market was down another 27%. So here we came off a year of down, 30, 35%, then another 27%. But like I'm showing here, when it was all said and done, it was actually a great year for the market. It was up 28%. And it's hard because now it's been over a decade, since then, but it's not that there was a lot of good news at that point, right? And that's what's so difficult when you start trying to time the market, is we can get wrapped up in all this short-term information. But what, one of the takeaways from our talk today when it comes to building a portfolio is not for what's going to give you the best shot at success over a 1 month period, right? A 3 month period, a 6 month, or even a 1 year period, because if you look at all the data, and I don't believe anyone that has a crystal ball, no one knows what the market's going to do over the short term. And so that's not how you should be investing your money. You need to make sure that you're investing for the long term. And I don't mean, some of the charts we'll go through, right? If we look here, I mean, I guess this is just going back to 1970. If we go through, like right here, let me do this. This right here, this goes all the way back to 1926. And I know it's always tough, right? When you hear talks like this, oh, well, if you look, over the last 100 years, here's what the market's done. But I realize that none of us have another 100 years. But even if you look at 3, 5, 7, 10-year periods, the market returns positive performance. There have been certain time frames to where, like, the Great Depression was the worst we had ever seen. But when you're building a portfolio, you just want to give yourself the best shot, right? Because there are no guarantees and the highest probability of success. And one of the key things to keep in mind when it comes to managing your portfolio, during these times, is making sure that you don't miss some of the best days that the market has. And, the issue with that, and what we've seen recently, like I printed something out right here, if we look at the best point gains that the market's, ever had, well, 5 of the top ones have been in the last couple of weeks. Now, overall, of course, the market's still down, and it's still down quite a bit. But it's so easy when you're timing the market or trying to time the market to get out and be on the sidelines when some of that then positive performance comes back, and it can come back quick. let's say, Monday, right? I mean, nervous with what's going on in the world and the markets. If I was to pull out, and I'm not saying that the market could not, continue to go down from here moving forward, but you miss out on some of these days where there might be 10, an additional 5% or a total of 15% over the last couple of days. You start missing those, and that can dramatically, drag down your performance over time. And that's what this is showing. If you look, this is a time period, 1990 until through the end of last year. So a 30-year period, pretty long period of time. But the S&P 500 over that 30 years, what it's showing here is that, you would have earned about 10% per year. Well, let's just, go to, if you miss the 5 single best days the market had, which again can be, dispersed through some really bad days. And even in 08 and 09, there were some pretty significant up days. Well, just missing 5 days over 30 years ended up dragging the performance down on average about 1.5% per year. And then if I go all the way out here to the, almost the far right, but if you missed, not even 1 day per year over that time period of those best days, if you missed the top, 25 days the market had, it dragged your return down from a 10% return to about a 5% return. And those are the types of things that can, cause people to fail, financially when it comes to prudently managing their investment portfolio. But I also get that it's tough, right? And unfortunately, the market or, our decisions a lot of times are based on fear and greed, right? So when you have times like last year, 2019 was a great year for the stock market. Well, then people feel a lot more comfortable, right? And they say, okay, well, maybe I had safe money in my portfolio, whether it's cash or short-term bonds. If I look at what the market's doing, I want more of that, right? So people then tend to deviate from maybe what their original game plan was, or maybe they didn't have a game plan. They tend to then go heavier in stocks because, times are really good, and then when we're going through periods like what we're going through now, we're even after today. And again, this could be, in getting started for this, it might not be the closing of the market, but even after the last couple of days, the Dow's still down 24%, the S&P 500 still down 21%. So you want to make sure that, and it's such a simple statement, but you really want to make sure your portfolio is set up for the good and the bad times so that you're not caught in a position where, like if I went very heavy in stocks last year because I felt more comfortable because the market was doing really well. Well, of course, now when the market's pulling back, if that wasn't, part of my investment game plan, well, then, I could be in a really bad spot, at this point. But it's making sure that it's set up for the good times and the bad times. Just, I don't want to dwell on this, but like if we go through this chart here, there's always something, right? And I know anytime we're going through anything, like COVID-19 and the coronavirus, it feels like the worst thing. And it is different, right? I mean, that I'll never deny that. Like this actual event, we've never been through, right? And I've never been through personally where we're quarantined, in our house or being asked to stay at home. I think, we're adjusting. I mean, I'll tell you, like for me and my wife, and we've got 3 kids, there's definitely been an adjustment period there. And so this is a different event, but it is always different, right? And, without going through, of course, we could argue what's worse than others, but I just think it's a good reminder that there is always something. I mean, just to touch on here, like in the mid 70s, right, the oil embargo, and then when Nixon resigned in 1973, 74, S&P was down 43%. I believe it recovered, maybe about a week later. Early 1980s, inflation was through the roof, interest rates were through the roof. Then we had 1987 with Black Monday, and if you remember, like the late 80s and early 90s with the savings and loan crisis and real estate crisis, here in San Diego especially. So there is always something, and you just don't want to try to get in a position to where you are trying to predict it. So like here, and some of this is basic, but as you can imagine, we have all different types of people, on this call, different areas of knowledge. And I think no matter how well you understand the market, I think this will be a good reminder of how we do tend to invest based on emotion. But I know some of these are abbreviated, but all this chart showing, and some of you have maybe seen this, is, it's, I guess kind of a nerdy statement, but this is one of my favorite charts only because it does show, how our emotions come into play. And so what this is charting out is that the top row here would be the best performing category of stocks or bonds. This would be the worst performing category of stocks or bonds. Now, if we all had this ahead of time, this would be really easy, right? Because we would just always continue to invest in what we felt was going to be the best, or what we knew was going to be the best performing asset class. The problem is we don't have this chart ahead of time. right? We have it only looking backwards. And unfortunately, that's how a lot of people make their investment decisions. So like here, 1999, again, there's some abbreviations, but this is emerging markets. So this is, smaller international countries, Brazil, Russia, India, China, up 66%. So people look at that, and and there was some positive performance right before that as well. But people buy it, right? Look, geez, it's up 66%. I need more of that. Well, then the following year it's down 30%. So then guess what everybody does? They sell it, right? So I bought when it was up here. Now I sold when it's down here, and maybe I'm glad for a couple of years I did, because it's down 6%. But then here we go again. It's up 55%, 25%, 34, 32, 39. You go through these streaks. People then buy it, and then it's down 53, then it's up 78. I mean, you could pick a lot of these, right? Like real estate, up 33%, up 10%, up 38, but then we go through a period of time that where the next couple of years, it was down 50%. The way that you want to structure your portfolio, and obviously as part of this call, there's not any specific recommendations, only because everyone is going to have a different plan, or, may have a different plan, but it's just, the most prudent way to invest your portfolio is, I wish you could know which one of these categories was going to do best every year. And of course, you keep it simple. You just invest in that particular category. But since we don't have that information, and no one's ever been able to consistently time and beat the market, a prudent way to manage your portfolio, whether it's going into times like these or during times like these, is to have a blend of all of them, right? To where one thing, unfortunately, I can guarantee you, is that you'll never have everything in the best performing asset class. It's impossible, because you'd want to have a blend of everything. But what I can also guarantee you is that you'll never have everything in the worst performing asset class. So like this white box is just an example of having like a 60% stock, 40% bond, fairly typical allocation, to where, there's still down years. I mean, like, of course, a 60% stock portfolio this year is down. 2008, it was down, 21% based on this, index portfolio. But it's consistent, right? To where it's down the middle. And then what you really want to take advantage of, during times like these, if we do assume that you have a well-diversified portfolio with a blend of all these different asset classes, and I guess even more high level, you want to have some safe money in the portfolio, right? So like I said earlier, cash, short-term bonds. Unfortunately, I've been seeing more and more people take a little more risk on the bond side of the portfolio over the last couple of years, because you can squeeze out a little extra return during the good times, but just like 2008, where it's labeled here high yield, these are lower credit quality bonds, to where there were years before where you could get a higher return. Unfortunately, those are the bonds that get hit hardest during times like these. So I am a firm believer that if you're going to have safe money in your portfolio, then keep it safe, right? Short term, high credit quality, low risk, low return, and then on the stock side of the portfolio is where we're compensated to take risk. But while you have this volatility, what is so hard to do emotionally, but what you absolutely want to look at your portfolio now and potentially take advantage of is, things are down. Now, I know it feels like it's not the right time to buy more, and I don't feel comfortable recommending to anyone, buying individual stocks, because I don't know, I mean, whether it's Apple or Amazon, I mean, any one company can go out of business, and I'm not saying either of those companies will go out of business, but hindsight's always 2020. There have been some large, big businesses that have gone under historically. So when I talk about buying more, I wouldn't feel comfortable saying, okay, well, Apple's down, let's buy more. Then it goes down more, let's buy more, because again, one company can go under. But if you're using, well-diversified funds, whether they're institutional funds, index funds, exchange-traded funds, I do feel confident, as long as it's part of your overall investment strategy, to make sure that you're buying more. Because if you buy more while things are cheaper, it helps your portfolio come back a lot quicker, because you're buying more shares. And there's no way to predict the bottom, right? So, that's what's, so difficult is, like right now, okay, as of today, Dow's down 24% still, even after the positive performance the last couple of days. Well, if I was to buy more, well, maybe the market does continue to go down. But if I maintain that discipline and continue to buy more shares as things are cheaper, like I said, and I'll show you a chart on this, that things do recover a lot quicker. And you don't necessarily want to just start taking cash. You want to have a good cash reserve. I mean, maybe you've been sitting on the sidelines. Now might very well be a good time to be deploying some of those dollars. But at the same time, if you do have safer money in your portfolio, it's using those safer dollars to either cover your income needs during these time periods, because you want to make sure, especially if you're retired. I mean, most of my clients are, either nearing retirement or in retirement. You want to make sure you have that safe money to live off of during these times, but also use those dollars to then buy more equities or buy more stocks. And what this is showing, I'm actually just on that topic, I'm going to come right back to this, but this is then showing that concept, and it's such a simple thing, but I think it puts that, kind of brings all that together. Where this was, the worst time period over the last 20 years, of course, was the end of 07 to the beginning of 09, like we were looking at one of those first charts. The S&P 500 was down 51%. There was a 16-month downturn. Well, here, a 60% stock portfolio, still down. I mean, it's better, right? But again, hard to say that that's, no one's thrilled with a negative 35% return. But what I like to see, in this stress test here is under this column, subsequent months to recovery. So it took the S&P 500 3 years or 36 months to get back to even after that downturn. But for, a well-diversified portfolio, it took 19 months, which is still, close to a couple of years. But, one thing is, of course, if you don't have everything in the stock market, it's easier to recover. But then the second thing is this does assume that you rebalance the portfolio and you bought more. So, when we start with the first thing, to take advantage of during markets like this, it's rebalancing, right? So having a prudent investment strategy in place to where, at least for me and like for our clients, we set different thresholds, and even if you're managing your own money, I think that's the right way to do it. It's so hard to get caught up in the emotional side of things, regardless of who you are. So I think what you want to do is have a target, for what percentage you want in any given asset class, and then setting an upper threshold or an upper limit and a lower threshold, to say, okay, if it goes up enough, this is when I'm going to then sell some. If it goes down enough, this is when I'm going to buy more. If you put that in writing, I think like any good financial planning or investment strategy, having something written down so that you're not looking at the news and saying, okay, now with the stimulus package coming out, I believe the market's going to turn around, it's going to do this. It's just really easy to get caught up in that. But if you have, hey, if I'm shooting for 20% of my portfolio in a particular asset class, it goes up to 25, to use as an example, I'm going to take some of those gains off the table. Or if it goes down to 15, then I'm going to make sure that I'm buying more. And, that's where you just want to make sure you are maintaining that discipline so that things can recover a lot quicker. So when we talk about things to take advantage of during this downturn, rebalancing, as part of a long-term strategy absolutely makes sense. But then, a big part of what we can take advantage of too is from a tax perspective. Now, a lot of what I'm about to go through, is making lemonade out of lemons, right? Because none of us are thrilled that the market's down, but the market's down, right? So then, what can you do to put yourself in an even better spot? So let me just transition over really quick. All right, so let's do this. So let me walk you through conceptually, I guess from a planning perspective, what people want to have is good tax diversification. And, so this is going to be an abbreviated version of what I normally walk through, because there's a lot of different, income limits, and things that you want to make sure that you're aware of. So for today, we're just in essence of time, we're just going through concepts so that you have a good idea of what maybe it makes sense to look more into. Like that would, I would be happy if, you picked up one or two things that made sense, to maybe dig a little further into, but, just know that there are, income limits and a lot of other details that you want to look into here. But, the way that I've described it is that, there's a few different pools that you can have your money in, or different types of accounts you can have your money in. Each of them are taxed differently. So the initial part of this is just going to be education on what each of these pools are, but then we'll start getting into some strategies to potentially implement. So there's tax-free accounts. So a tax-free account, for today's purposes, we're going to just touch on Roth IRAs, but any future growth or income from there, you don't pay any taxes, right? 0% tax. Could also be municipal bonds, if you're using municipal bonds in a portfolio, but for today, again, it's going to be the Roth IRA. Tax deferred, these are our tax deferred assets, of course, like 401ks. If you work for a tax exempt organization or a school, it's a 403B, it could be a 457. If you're a government employee, TSP, but employer sponsored plans to where, you're taking advantage of making contributions into those types of plans. You get the tax benefit going in, right? It's reducing your taxable income. But then, and this also just covers traditional IRAs, whenever you draw money from those accounts, it's a little harder to write on this iPad here, but you end up paying ordinary income. So you get the tax deduction now, but then whatever future growth and the principal, you draw that out and you end up paying ordinary income tax. And then taxable, just to keep this one easy, this is just anything outside the shell of a retirement account, right? So this would be what's referred to as non-qualified investments. So that could be stocks, bonds, mutual funds, real estate falls into this category. It's just anything outside the shell of a retirement account where if I hold those assets for more than a year and I have a gain, well, then I pay long-term capital gains, which for most people, it's different. It can be as low as 0%. It can be as high as 20%. But for most people, it's 15%. But really the bottom line is, when you look at whatever tax bracket you're in, which I'll touch on, how you determine what tax bracket you're in, but all this money comes out like regular income subject to whatever tax bracket you're in. Well, regardless of what capital gain rate you're paying, 0, 15, 20%, it is always lower than whatever your ordinary income tax bracket is. So, one thing that I want to discuss that only applies to this pool right here, non-retirement accounts, is looking at potentially tax loss harvesting. So this is where we've been really active with our clients, and it's definitely, something to consider if it makes sense for you. But tax loss harvesting, which again does not apply to a Roth IRA, it doesn't apply to a traditional IRA or 401k, but it's taking advantage of this, volatility to help you at least tax-wise. So we could have a year, and here's basically where we're at this point. I don't know what the future holds, but I'm going to be optimistic and say that the market recovers and it ends up being a positive year. So regardless though, at some point, unless I'm banking on a handful of individual stocks, the market will recover, right? So during a dip like this, we've all been told, and I agree with this, advice, that you don't want to sell and get out of the market, right? I don't want to, go to cash, sit on the sidelines, and then, wait for the market to recover. But if I'm using funds, so that's an important distinction here, is this wouldn't, or it's trickier when it comes to individual stocks, but if I'm using a mutual fund or an exchange traded fund or an index fund to implement my portfolio, right? Let's say that, and I know this is just a simple way to look at it, right? That's my investment portfolio. And I have this part of my portfolio, large cap stocks, right? So this is more like my S&P 500 type asset class. So, I want to have large cap stocks in my investment portfolio here. Now I'm seeing that they're down, basically at this point with all stocks, but I'm seeing that that part of my portfolio is down. Well, I don't want to just, again, get out of large cap stocks, but if I'm using a fund, well, I can have a couple different funds that are almost invested identically, right? So I could have what I'm calling here Fund A and Fund B. And let's just assume both of them are invested in US large growth stocks. Well, during a dip like this, where I don't want to just buy and hold and ignore and just wait for the market to recover, this is where I might want to take some action. So what you can do is look to sell Fund A, right, invested in large growth stocks. I can turn around the same day and buy Fund B, so I'm not sitting on the sidelines. So when that asset class or when the market recovers, I'm not going to miss out on that. So I'm still invested the same way. Like that's what's important here, is I'm not altering my investment strategy at all. If I've determined, using it as an example, I want 20% in large cap growth stocks, I'm still keeping that, but I'm just switching between two different funds that I feel like are, pretty similar or pretty close to each other, so that I can then take advantage of that, loss on Fund A here from a tax perspective. So let's assume I had $250,000 invested in that part of my portfolio. Now it's down to $150,000. Well, then I'm taking, $100,000 in losses. So again, the goal is not to lose money, right? But if we know that markets do this, it's taking advantage of that. So now I have $100,000 in capital losses. So for some of you that are more detailed, you might know that we're limited on how many losses or how much in losses we can take each year against regular income, and it's $3,000, right? So if I don't have any other capital gains, I am limited to only using $3,000 to offset all my other income. But if I do have any other gains, then I can offset those dollar for dollar. But let's start with the first example here of I don't have any other capital gains. I get to use the $3,000. Well, then I carry forward indefinitely as long as either I'm alive or if I'm married, as long as my spouse is alive. I don't lose those losses. Those do carry forward forever, where I guess, I could use $3,000 every year. But in all likelihood, I mean, if I have a good investment strategy in place, at some point there should be gains, right? So what I'm dealing with now is then potentially using this as an opportunity to bank some of these losses to then help me offset future gains, so that when we talk about drawing money, or when, kind of mention it, I guess, on this call, when you start drawing money from that pool, that non-retirement account, if you can offset gains and losses, then, you can almost make that not necessarily a tax-free pool, but a very tax-efficient pool of money by, monitoring portfolio, taking advantage of losses when they're there, and then offsetting future gains as you derive your retirement income from that side of the portfolio. Also, maybe I have a rental property, so stocks can offset real estate and vice versa. So if this is my stock portfolio and it's down $100,000 and I take advantage of that tax loss harvesting, and maybe I've been holding on to this rental property that I've owned for a long time, but it has $100,000 in capital gains, so I haven't necessarily wanted to pay the tax on that, I could use that $100,000 in losses, in this example, to then offset those real estate gains. So like I said, and I say this all the time to clients too. I mean, this is all, making lemonade out of lemons, but I mean, it's a fact of where we're at, right? And so you at least want to take action. I think even this is still better than some of the alternatives, but during bad markets, I think people just close their eyes. Maybe I've heard a buy and hold strategy is the most appropriate. So I'm not going to let this get to me. I'm going to just ignore it, wait till things come back. And that's better than, of course, pulling out of the market or making dramatic changes during these times. But at the same time, you want to take some action, right? You want to take action. Okay, does tax loss harvesting make sense? Should I be, buying more? Should I be rebalancing my portfolio? And I think both of those are good ideas. The one other thing, and I won't relabel all of these, but like when we look back at these three pools, so what we were just talking about again was over here in this taxable pool, non-qualified investments. So like a brokerage account, right? If I have like an investment account in the name of my family trust or in my own individual name, that's what we were talking about there. You can't take advantage of that, inside of an IRA or a Roth IRA. But the one other thing to consider during these times is whether or not a Roth conversion makes sense. So a Roth IRA, which is, again, I'm just going to list it as an R up here. The benefit of a Roth IRA, just to start with this, is that I don't get any tax benefit going into a Roth, right? So whereas when I put money into my 401k or my traditional IRA, I'm lowering my income, right? Then we knew, though, that the downfall is on the flip side. I do end up paying tax on that money on the way out. Whereas a Roth IRA is the opposite. I don't get any tax benefit going in, but all future growth or income comes out completely tax-free. So there's only a couple ways to get money into a Roth, and one is you potentially could make Roth contributions. If I'm under 50, I can put in $6,000. If I'm over 50, I can put in $7,000. There are income thresholds. So, well, first of all, I have to have earned income. So in order to make a Roth contribution, I have to have working income. So that's not Social Security, pensions, interest, dividends, things like that. But W-2 wages, 1099 income. So I have to have earned income, or if I'm married, at least one spouse has to have earned income. So like my wife stays at home with our 3 kids, which for sure is a job, in and of itself, but no one pays her for that job. So she doesn't have earned income, but as long as I make, we're under 50. So as long as I make more than $12,000, then both of us can make a Roth contribution. But one thing you want to look into if you are going to make a Roth contribution is at a certain income level. If you make too much, then you're not able to make Roth contributions. So I wanted to at least touch on that because that is one way. And maybe if I've been planning on making a Roth contribution for 2019, because by the way, where we're at in the year, I can, as long as I'm eligible, I can make 2019 Roth contributions all the way up until tax filing. I can also make 2020 contributions at this point. So if that's already part of my strategy, while markets are depressed, it might make sense to look to make those contributions during these times. But the one thing that you also might want to consider is whether or not a Roth conversion makes sense. So that's where you're taking dollars from down here in my 401k, my IRA, my tax deferred assets, and I'm moving those into a Roth IRA. Now, of course, there's a downfall, right? And that downfall is there's no way around the tax. right? So, as a reminder on those tax deferred assets, there's required distributions at a certain point where you have to start drawing money from them. If I leave them to my children or my heirs, they'll end up paying those taxes. So there's no way around the tax. Same idea here, moving that money from an IRA to a Roth IRA, no way around that tax. So most people wouldn't necessarily want to consider converting at all, right? I mean, like if I had $1 million inside of my 401k or my IRA, I could move $1 million from there up to a Roth. But what that's going to do is be like I made an additional $1 million. So any money you move from your IRA to a Roth, it gets added on top of all of your other income. So whatever tax bracket you're in, that's how that's going to get taxed. But if you converted $1 million, just to use a big example, it's going to push you up into the highest tax bracket. So you'd end up losing a lot of that to tax. So I don't want to get into too many details just based on time, but you don't have to have earned income to do a Roth conversion. If I'm retired and, maybe I'm living off of cash or some of my taxable assets to where by offsetting gains and losses, I can keep myself in a really low bracket, that could be an awesome time to do a Roth conversion just from a tax perspective. So, before you take any action to consider during these times shifting money from an IRA to a Roth, I think first you want to make sure it makes sense tax-wise. And so what I mean by that is, what tax bracket am I in now? What tax bracket am I going to be at in the future? Right? Because some people, let's say I'm going to retire next year and, this year I make $500,000 a year. Next year, I live a pretty modest lifestyle. I'm going to have Social Security. Maybe I have a small pension, but, that person could end up in a lower bracket. But for a lot of people, they won't necessarily end up in a lower bracket. And it's because they try to maintain the same lifestyle in retirement. And I think that's what most of us try to do. So real quick, I'll come right back to this, but like if we look at, this is just a simple drawing, right? But if we look at the federal tax brackets, and they're all the same in terms of the percentages, but if I'm a single taxpayer, married filing joint, head of household, all the limits are different. But let's just use an example where, $100,000. That's what me and my family need to live off of when we retire. And right now it's perfect. I work, I make $100,000 a year. So, that does keep us in this 22% tax bracket, and that covers all of our income needs. Well, the argument, against shifting money to a Roth IRA might be, well, Mike, I'm going to have just Social Security, let's say once I retire. So that's only, $25,000. So obviously I'm going to be in a much lower tax bracket. Well, it depends on how much you spend though, right? It's not just what your fixed income is, because in this case, yeah, if you just live off of Social Security, if it's just Social Security, you actually wouldn't pay any taxes, but you'd be in a much lower bracket. But for a lot of people, if I'm trying to maintain that same $100,000 a year lifestyle, all right, some of it's coming from Social Security, but then the question is, where is this other $75,000 coming from? And if all that $75,000 is coming from my 401k, that's all tax deferred, well, that's all going to get treated like regular income and potentially push me right back up into the same bracket. So again, you want to know what tax bracket you're in now. On 2018 tax return, it's line 10 on your tax return. It's taxable income after all of your deductions. This year, for most people, it's on line 11. So pretty close, but the bottom line is it's taxable income after all of your deductions. So you want to make sure it makes sense tax-wise to where, okay, what bracket am I in now? What bracket realistically am I going to be at in the future? And let's use this same example while we're on this page and say, okay, well, yeah, based on that, yeah, I am going to be in the same tax bracket in retirement. Well, then maybe a good strategy is from a tax perspective to slowly, not do it all at once. For a lot of people, it might be a 5, 7, 10-year plan to slowly start shifting money from an IRA to a Roth IRA. And don't do too much, but potentially just enough to maximize the tax bracket that you're in, right? So hopefully that makes sense. But to sum that up, if I'm in the 22% bracket now, if I foresee that I'm going to be in the 22% tax bracket in the future, shifting money from an IRA to a Roth IRA just to maximize that 22% tax bracket could make a lot of sense, only because, yes, you're biting the bullet and you're paying extra taxes, but then all the future growth is completely tax-free. So that is the main criteria, when you want to decide on whether or not you do a Roth conversion. But if it does make sense from a planning perspective, right now is an ideal time to do a Roth conversion. So it's because the market is down, right? It's been depressed. So if we do assume, and again, there's no guarantees, but if we assume that at some point the market is going to recover, well, if I just kind of take, let's say, two of those circles and say, this is my tax deferred IRA, this is my tax free, this is my Roth IRA. Well, what I can do, I don't need to sell, right? So if I have, let's say emerging markets or large cap stocks in my traditional IRA, I can take that holding, which is part of my investment strategy, and convert shares from my IRA to a Roth IRA while it's down in value. And then when that recovery comes, it's all going to be inside of my Roth IRA, right? So again, you want to make sure it makes sense tax-wise. But I'll also tell you, I've had some talks with clients over the last couple of days to where, maybe on the surface, I looked at it and I said, I'm thinking of this one particular client where, you're in the 12% tax bracket right now. You're already drawing from your portfolio. You already have your pensions. You already have Social Security. You're probably just going to continue to be in that bracket. So earlier this year or last year, Roth conversions didn't really make sense. Then you get the market, getting hit like it has. And not to say that it can't continue to go down, but when it's down 30%, well, then you want to start going through, some other math of saying, okay, well, if I'm going to pay a little extra tax to get it there, how much does it need to recover? And like in their case, just to use like a real life example, they are in the 12% bracket. Now we're considering actually going into the 22% bracket to do Roth conversions. So that's 10% additional tax. But, in that case, you just need to believe that at a certain point, when I actually do need to draw those dollars out, that it's going to recover by more than 10%. And again, who knows? But if it's more of a long-term strategy, when markets are down, now it's a little better, right? But if they're down 20, 30, 40%, and maybe you even choose some of those asset classes in your portfolio that are hit the hardest, right? Like small cap, value, like some of these harder hit asset classes might be ideal to move from those accounts into a Roth IRA. So again, all that recovery is completely tax-free. So, that is important, and it kind of goes beyond the scope of this hour that we have together. But, when you look at your portfolio, I mean, even just in general, you do, like, let's say this is 50% in bonds or safer money. This is my 50% in stocks. You want to have your higher expected returning categories, in your Roth IRA, because all that growth's tax-free. You do want your safer money inside of your traditional IRA because all that growth gets taxed like regular income. So it, again, can be even more of a reason to start shifting some of those, sometimes more volatile, sometimes more aggressive holdings in your portfolio into your Roth IRA. Take advantage of things while they're down in value, so that, again, that market recovery ends up happening in your Roth IRA, which is tax-free. It can be a great, pool of money to draw from, if there's big unexpected expenses. It passes on to the next generation tax-free. So, I mean, lots of benefits, but, we won't really go into it. And I know I switched up some of these circles, but if I throw in that taxable pool again, really the ultimate goal from like a financial planning standpoint or a retirement income planning standpoint is to have money in all three of these pools, so that when you're drawing your income out, remember that person that had Social Security, and then all of it was coming from their tax deferred account. Well, now, yeah, maybe I can pull some from my tax deferred account, pay 12% in tax, pull some from my Roth, pay 0, offset gains and losses in my taxable account, pay, 0 or very little in that account. So, from a planning perspective, especially when it comes to like cash flows in retirement, this is a concept I go through quite a bit, but also helps me illustrate, some of the strategies that do make sense during these times. So, I know it's, having taken a breath or a sip of water. I mean, it's a lot of information, and I get it. It's a relatively short period of time for us all to get together. Other than me being, busy with work and helping clients, the one thing I've heard from most people when we talk about setting aside, times like these, for a lot of us, we do have time, right? We're in the house. And so, I mean, some people just do enjoy this, but I think that's kind of the world that we're in, where, I had a call last week where they were like, oh, this is the most exciting thing we have going on all day. Which I get excited about. Like, I enjoy taxes, but I get that, maybe that's not necessarily everyone's, area that they enjoy. But yeah, I mean, kind of in a summary, and there's some follow-up items I want to go into. What I would look at doing is, I think in general, this is a great time to just reassess your overall game plan, right? I mean, hopefully everyone had a plan in place, going into this, to where their portfolio was set up for the good times and the bad times. But I know that there are a lot of people that weren't, right? And so if you look over the last, 10 years, I mean, we've been in a strong bull market. And so unfortunately, people do start taking more risks than they probably should. So, you don't want to react. You don't want to have a knee-jerk reaction to what's going on in the market and totally change things up. But I do think it's a good opportunity to look at, okay, this is a reminder that markets can go down. They can go down quite a bit over short periods of time. Am I prepared for that? What's the game plan? But if you do have a well-diversified portfolio and you have that, in place, then, right now can be a great opportunity to be rebalancing your portfolio, buying equities or stocks while they're down, being real smart about, if you are retired, where you're drawing your monthly income from, so that you're not forced to sell stocks when they're down. And then tax loss harvesting, if you have non-retirement accounts, making sure that you're taking advantage of tax loss harvesting opportunities if that's appropriate. And then also, whether or not Roth conversions made sense late last year, earlier this year, it is something to consider, just because the markets are down, potentially taking advantage of that. But new news is coming out every single day. I know these are tough times for everyone to get through, which is why, just last week, and, I really appreciate the rest of the team, pulling a lot of this information together, because, things are happening so quick, right? Last week, I know we all chatted and we said, hey, we got to get something set up to just, try to get some, more information out there, but just not more the same, right? I mean, of course, there's bad news, and it's so easy to get wrapped up in, what's going on, in the world, and the additional cases that we're seeing and the lockdowns. I mean, it's overwhelming, right? So, we wanted to kind of take a step back and say, okay, well, there are some things to take advantage of during this time, but at the same time, like a prudent investment strategy and making sure your portfolio is set up appropriately, even though a lot of this is the same that I would have recommended a year or two ago, it's just a good opportunity to kind of, chat about it. So hopefully you got something out of this. But, one thing that we also talked about as a team is, this is a lot of information over a short period of time. I also teach a lot of retirement planning classes at local colleges, and, that's usually a few hours and a couple night course. And that's a short period of time. So, kind of picked out a few things where I thought you might get the most benefit, but I get it. It was a fire hose, even for me, right? Trying to meet this, one more time frame, and trying to get as much information out there as possible. So if anyone wants to chat, as a follow-up on, getting a second opinion on, maybe what you're doing now from a portfolio standpoint or from a tax perspective, do any of these tax strategies make sense? I don't prepare tax returns, but, a big part of my planning is tax planning, and then, coordinating with either clients or their CPAs. But we're happy to offer a free financial checkup, which is something that we do from time to time, or already. But again, I think with everything going on in the world, it is a good time to reevaluate things. And so what, happy to do, one, answer any questions, and I will, take a couple of questions before we get out of here. I see that there's a few in the chat box, which, by the way, let me just pull this up real quick. Doing two things at once. All right. So just to get some content, well, let's just go through this real quick, right? I mean, this is what we deal with, right, with the noise of the market, but it's an airplane, right? The pilot's indicated we're going to go through some turbulence, fasten your seatbelts. Somebody's screaming, we're going to die, right? This woman's explaining to the guy next to her, oh, well, he's just a financial reporter. So what you really want to do, which is very difficult, but you want to be this guy or girl over here on the bottom left, right, that tries to tune that out as much as possible. But, right down there, you can see that there is a chat box. I'm going to, pull up a couple questions from that. But, before we get going, if anyone wants to take me up on that, great. If anyone doesn't, that's fine too. But happy to go through, like I mentioned, just looking at last year's tax return, see if there's any tax strategies moving forward. Do Roth conversions make sense as a long-term strategy? Look at your investment portfolio, talk to you about the risk and return that, the risk that you're taking for the potential return, give you an idea of internal fees. So, outside of the markets and taxes and all that other stuff, truly, I hope everyone's doing well and staying safe, puts things in perspective of what's truly important. And, again, things I think we take advantage of. For me personally, being able to see family on a more regular basis, those are the things that mean the most to me. So, hopefully we will get through this, but, hopefully we get through this sooner rather than later, and everyone takes care and, stay safe. We'll send out my contact information if anyone, has any questions, even in addition to that evaluation, feel free to reach out. Happy to help any way that we can. So I'm going to sign off, but again, hope everyone be well, and we'll get through this. Take care, everyone. Bye.